Your market news now. Asian shares struggled to advance. However, the equity benchmark is heading for a monthly gain driven by a rally in Japanese and Chinese markets. There's still plenty of uncertainty in markets over factors such as the path of potential Fed rate cuts, as well as the likelihood for more support measures from China. In commodities, global benchmark Brent traded above $82 a barrel after rising yesterday, while gold steadied near a two-week high as the market waits for clues on when the Fed will start cutting interest rates. To give us perspective on the latest when it comes to the markets, we are joined by Makwe Masilela from Makwe Fund Managers. Makwe, thank you so much for your time. What is actually driving the market right now, and how would you describe sentiment?
You know, markets are driven mainly by, we're expecting more of economic data coming out this week. Already, we've got that higher than expected inflation number that came out of Bank of Japan, which is also telling us that probably the Bank of Japan will start moving out of the negative interest rates in the coming month. And also, we'll be waiting to see any comments coming out of the central bank officials, as markets are just looking for any clue to know when interest rates will start going down. So markets are just looking forward to that. And anyway, without any catalyst, the markets have all the reason to take more of a breather more than anything.
We can say we're in results season for South Africa. I mean, tomorrow we've got Cashbuild, the next day it's Santam and ShopRite and the like. When you look at some of these companies that are due to release their figures in the next month or two, what are you looking out for?
You know, when it comes to our food retailers, we expect them to continue to be printing money in the sense that we know that more than 60% of our people spend more than 60% of their income on food, but we'll also be watching out on the cost as well, because we know that they tend to spend a lot of money on diesel to make sure that they keep those stores open. And also into the legs of Cashbuild, we know that since the days of COVID have passed, people are no longer spending much money to improve their home environment as they used to work and study from their home environment. But we like to see, the number of transactions that went through the tills and how are they coping with their internal inflation, because that continues to be key. The long and short is that we don't expect local results to be shooting out the lights, because all these companies are facing difficult trading conditions.
Let's talk about SESL. They released their earnings yesterday, and it was quite interesting to look at the share price reaction. But what do you make of SESL as a stock, given where it's trading, 148 Rand a share, looking at the PE ratio as well as, let's bring in that dividend yield?
You know, if you look into those metrics, you look into the PE, you look into the dividend yield, that will show you that it's very attractive. But now you've got things which are not yet factored in, the possible headwinds going forward, because we've seen what happened to the chemical prices, down almost 24%, Brent crude down almost 10%, and all because of the macro environment more than anything. But for me, the biggest concern is that since, well, we know they'll be looking for more cash going forward, will the guys probably revisit that idea to start looking into doing the rights issue? So I think that for me we need some certainty when it comes to that. We know that idea was canned at some point because they managed to sell enough assets to be able to pay some of the debt. But should the global economy start improving, as people start thinking that we'll probably have a soft landing more than anything, then probably their commodity prices will start to improve, and hopefully they start benefiting out of that going forward.
We're expecting Aspen to release their results on the 4th of March. We haven't spoken about Aspen, at least between myself and you, but what do you make of Aspen?
You know, once a darling of the market, and during COVID is one of the stocks that was flying. But yes, I think it's just priced for perfection at a PE of 13. But we expect the guys that going forward, they will at least start benefiting from all this investment that they've been making, the long-term contracts that they've been signing with guys to be their distributors and their manufacturers. But as it is now, it has been disappointing coming out of that. And their dividend yield of 1.8, I think maybe it needs to be improved going forward. But yes, we're all waiting to see this time around, will they just give us something more decent so that it can come back to be the darling of the market that it used to be.
If you're to think of the challenges between SPAR and Pick n Pay, who's got it really bad here?
I think, unfortunately, it's Pick and Pay, and because the guys are struggling to implement their strategy, and we don't even know that that strategy will be going ahead, as we've seen that they've changed the CEO because of the implementation of the strategy. And you look into their PE of 94, it's just something which is out of this world. But yes, their challenge to try to penetrate this lower LSM, they're only doing that with the light of your Boxer. But you look into the presence of Boxer, it's not that impressive. I think SPAR themselves, they've just made peace with the fact that the lower LSM is not really where they're playing. They just have one leg, when it comes to that. They're more concentrating on the middle LSM more than anything. So I think it's Pick and Pay, which they still have to prove a point, and bearing in mind that, unfortunately, we tend to compare them with the likes of ShopRite, because at some point, Pick and Pay was doing very well. So we expect them, or maybe our expectations are just too high. We expect them to just go back to what they used to do.
We've got 3 days left for the trading month for February. What would you say was a factor or two that drove markets in February?
All this excitement about artificial intelligence, all this excitement that, as much as interest rates were not going to be decreased come March or June, March or May, but markets continue to have the expectation that definitely, at least we're no longer debating whether they're going to cut interest rates. We're starting to debate about when and by how much. So I think that managed to give markets to continue to go up. But yes, that rally for me is not justifiable, because all those AI, companies, unfortunately, they are priced for perfection. So any slight mistake, then most probably will have some form of, whether it's a full correction or a mini correction, but there will be some disappointments.
All right, Makwe, let's leave it there. Thank you so much for your time. That is Makwe Masilela from Makwe Fund Managers. And tomorrow we're expecting U.S. fourth quarter GDP. This is the second estimate. You'll remember that the first initial figure came out in January, where we saw the U.S. economy grow 3.3%. So if this estimate comes in a little bit higher than the previous one that we got, it could give the dollar a reason to rally. But it also reinforces the idea that the U.S. economy is distancing itself from the slow growth that we are seeing in Europe.